I'm going to just do an update on the state of the gold market and look at the impacts of the rising precious metal prices to big companies and, more importantly for us, the implications on the small ones right now, and why I basically selected these 5 companies. So starting off, we know gold price is up. So gold price from the mid-March low of about 1487 went up to a mid-August high of about 2013. And we're rolling into one of the big uncertainties is coming up with the US presidential elections, which will lead to a lot of uncertainty. And a lot of that uncertainty is driving ETF demand, which is basically the principal source of demand right now that's driving the gold price, because everywhere else, jewelry, bar and coin, and even central bankers hanging issue and continuing negative real interest rates and the impacts of the COVID-19 pandemic on global growth and the subsequent monetary expansion. So if we lead on, I looked at a cohort of about 24 different leading gold producers. And out of these, cumulatively, they account for about $235 billion of market capitalization as of the end of August. So during that same time when gold was going up from mid-March to the end of August, these companies went up about, on average, 134%, showing their leverage. And they beat gold by about 4 times. So that's pretty good, decent leverage, which is what people or investors are looking for. But we'll notice that the junior index of the GDX versus the GDXJ even did better at 170%. So of these companies, they have about 440 million ounces of proven and probable reserves. And if you use the current production rates, that accounts for about 7 to 8 years of global mine supply. They're not great. I mean, out of the spectrum of low grade open pit heap leaches that tend to grade less than a gram to high grade underground operations, you've got a whole spectrum of deposits in here, and the average is about a gram. And you can see the companies that grade much higher, like over twice that average, over 2 grams. The yellow basically delineates those ones between the 1 and 2, and the other ones that are the white squares basically delineates the companies that are that have less than a gram in terms of the average of their reserves. Okay. And then if we move on, this graphic, basically, I'll explain this one in a little bit more detail, is that we've got the enterprise value per ounce, which is basically the market cap plus long-term debt, and I usually net out the working capital. And so you take that enterprise value and divide it by the ounces, which we just saw on the previous slide, the reserve ounces, and you get what the market's basically paying for their reserves. And the average is about $540 per ounce. And you can see it's basically in between in terms of how many companies are above the average and how many companies are below the average. And also, I've layered on how much free cash flow. And so free cash flow, with a lot of companies talk about operating cash flow, but since investing in these projects that are capital intensive are very important, I include free cash flow, which takes into account investing. And then I've normalized this, because we're dealing with a lot of a range between market cap and size of companies, by the actual revenue they generate. So the average is basically generating 15%. So if you had 100% of revenue, 15% of that converts to free cash flow. That's the average of these 24 companies. And you could see that there's a decent correlation between the companies that are like priced highly with respect to enterprise value per ounce above the average, and their ability to generate above average free cash flow per revenue dollar. The exceptions right now are basically Evolution Mining, which is out of Australia, and Agnico Eagle. Interestingly, I mean, Pretium, whatever you want to say about the resource, scores very well on this metric. And if you don't mind, the geopolitical risk of the Krieg Republic, Centerra Gold, looks to be a decent value, as we can see that generating above average free cash flow per revenue dollar, but they're being valued under, much under the average per EV per ounce because of where those ounces are located. Okay, now if we look at right now, these companies have been able to generate 4 times, the leverage to gold over that period from mid-March to the end of August, despite the fact that precious metal mines have been, a lot of these operations have been impacted by COVID-19 pandemic. The biggest impact on production has been uranium, and we'll point that out, but that's really mostly Kazakhstan. In terms of the number of operations, more than 100 each, both gold and silver have been the most impacted by the COVID-19 pandemic as it's, transferred from Asia to the Americas and hit Latin America pretty hard. And if we take a look at this, the estimate right now by the S&P Global Market Intelligence is about a reduction of about 2.5% of production in 2020 versus 2019, which amounts to about 2.7 million ounces. The biggest losses percentage-wise are again in Latin America, Argentina, and Peru. And Peru also has impacted greatly the silver production, and as well as has Argentina. In terms of gold production, even though the percent is higher than than the average of 2.5% globally, South Africa, due to the fact it's got a lot of underground gold mines, very labor intensive, they've had a lot of suspensions and shutdowns there in South Africa that has impacted gold production. Burkina Faso was the only sort of, so we're not in the same place that we were several years ago where a lot of people had significant debt. So if we look at the net debt, which is basically the long-term debt on a company's balance sheet minus their working capital as of the end of June, and all this data I'll point out is all about the first half financial metrics of all these companies. So if we look at that, a negative number where the working capital exceeds the net debt is good. A positive number is not good or unfavorable. So what we can see is the average for all these 24 companies is about 100 million of net debt. So they've got a little bit more long-term debt than working capital, which is still okay. There's quite a spectrum, but overall, there's a lot of companies that are below this average, which is healthy for the market. But we must remember, like in terms of these companies over long term, if we look at the retained earnings, which is basically a measure on the balance sheets on shareholder equity, looking at how much these companies have retained cumulatively of their earnings over the history of the company as a going concern. And you basically get an idea of the checkered history of these companies because the retained earnings, the average is about negative 1.1 billion. And only 5 companies have managed to generate retained earnings greater than 0. And so although the companies are got healthy balance sheets, the majority are generating positive free cash flow at these price levels. And one of the big reasons is a lot of the big companies, their reserves are actually still at $12 and $12 or $12.50 in terms of reserve prices. Healthy margins are also expected going forward, even if the gold price, is at 1,700, but now we're talking about 1,900 plus. So there's a lot of potential going forward, but what we want to avoid is the same sort of problems that these companies had previously, which was a lot of dilutive M&A. Okay, so let's look at how this converts to the small companies. Okay, so if we look at the big companies, we'll leave this last slide up where on a percent of revenue, we see what they're spending their money on. So I looked at the percent of revenue that they spend on G&A, on their corporate, that basically manages their portfolio of assets globally versus what they're spending on exploration. And you can see that they're spending almost 3 times on average more than they're spending on exploration. So they're spending about 4% on G&A, and basically the squares represent how much they're spending on a percent basis on G&A. The average is about 4%. Anyone below 4% is yellow. The lowest is Regis Resources outside of listed on the ASX, sorry. And the ones that are spending a lot more than the average are in the white squares. And if you look at the bars represent the percentage of what they're spending on exploration. The average is 1.4. And you can see companies like SSRM, Agnico, Newcrest, and Barrick are spending above average on exploration versus the group, but only SSRM is spending about the same level as their G&A. But what we must know is that what this might translate to is that the ones that are spending a lot on exploration, we may see more funding of juniors through private placements, even though right now they may not need it, joint ventures and strategic alliances. So we might see a lot more of that. And also for the companies that don't spend a lot of money or nothing, like the B2 Gold or some of these other companies on the left-hand side, they might just look at outright acquisition of operating assets. And then I will caveat some of this because this is all the first half of the year, that they might have been some COVID-19 travel restrictions that might have impeded some of these exploration spending. But this is a snapshot of what I saw during the first half. So the implications are that, okay, how does this translate to the juniors? And what we've seen is, basically the first several months of any year, we see financings because, for North America, at least, or for the Northern Hemisphere, that's when you need to raise money for the next field season because all these companies are non-cash flowing. So, but what we've seen so far is a definite uptick, basically from a low in April, if you look here, to an extreme steep rise in not only gold, but also we've seen in base metals and some, other specialty metals as well. So it's been an overall rise, but definitely gold's been important. And so we've seen that rise. And so we could say in June and July, the equity markets for junior and intermediates have raised over $1 billion each month, but here it translates into an issue. So we know that gold basically has gone up and it's been driven by ETFs, which became, come a little bit volatile. And, depending on what happens in the elections and if there's a vaccine found for the COVID-19 pandemic, then, that flood of paper might come out. A lot of it will come out in the latter part of the year. So there is a risk that some of these companies might be under pressure when their 4-month holds expire. Okay, and funding these projects, has been good. Financing risk has almost been mitigated over the last several months. So, but what we've seen is a pickup in exploration activity, obviously, and now the juniors have money that roll into the exploration season. And so most of the funding directed to junior golds, but we've also seen, even though we've seen a pickup in exploration, funding for the base metal companies as well, most of the exploration activity, at least for the number of distinct projects being drilled from this graphic from S&P Global Market Intelligence, has been in the gold sector. But what we got to also understand is that COVID-19 not only impacts production for companies, it also impacts exploration, and as I pointed out, when the pandemic had been slowly moving its way to the Americas, South America, or Latin America, which has a lot of precious metals, operations as well as exploration had been the hardest hit. So when you do invest in companies and you are looking at private placements and looking at generating news flow, you got to be aware where that news flow is going to be coming from and the jurisdiction and the implications of COVID-19. And is it going to slow exploration? Will I not see any news flow for 6 months, because they, touch a remote community? And so we've seen examples of this. Even in Alaska, we saw South 32 and Trilogy Metals, because they have a long-term relationship with NANA. They're trying to put in a 20-plus year, mining district up in the Ambler area of north central Alaska, they've decided to basically not have an exploration season this year. That way they don't impact the local native group. And also we've seen that happen in Peru, where grassroots explorers that may touch a remote community with no medical facilities, even though they haven't been asked to, they are refraining from exploring because reputational risk is very important for these explorers. And so when you do invest, that's something to be wary of. And so what I've done with the companies that I'm looking at, and also the companies that are presenting today, is all these companies have in common is obviously really good management teams, but jurisdictionally they're in places that can actually operate and generate news flow from the funds they've raised. Okay, so I'll just do a quick, one slide on each company that's going to be talking. And the first one's High Gold Mining, which is exploring a high-grade polymetallic JT deposit in Alaska. I mean, the key here, it's been dormant for 25 years, and even people in Alaska hadn't heard of it for a while. What appealed to me was the analog I saw to a deposit that I've owned through Mariana Resources in Turkey called Hot Maden. They had the same high-grade copper and gold mineralization, mostly gold, but also they had this big anhydrite mineralization, which this thing has as well. I'm not sure what the deposit analog is in terms of what it is, but definitely I could see it being similar to the thing I saw in Turkey, which was a stellar asset. So they've recently upgraded their resource, 750,000 ounces of about 11 grams gold equivalent. And this is all underground. And the management team, some of them ex-Constantine, considerable experience in Alaska. They recently raised money, and so they have about over 20 million in cash. And they just recently, which Darwin Green, the CEO, will talk about, released an intersection of over 70 meters of 18 grams gold and 0.5% copper and 7% zinc. So that's one of the companies that will be presenting. Another one in Alaska, Red Star Gold. This company has been around for a while, but they just recently closed a transformational transaction with a management team I know very well. And now they can change the approach to the UNG Project in Southwest Alaska along the Aleutian chain, which this company previously, Red Star, was hitting it with a few meters, and the news flow wasn't very good. The whole project wasn't managed very well. And now the company has raised funds, and now they're going in with 2 or 3 drill rigs and will be hitting it with about 8,000 meters. Even though they're hitting it, like now we're talking September, and you might think that that's late in the season. This is in the Aleutians. And so weather-wise, their season is much longer than normal projects in Alaska. Another project, a company, again, Gold Explorer, looking for low sulfidation epithermal veins, this time in central south British Columbia. I estimated a resource for the South Zone, which they discovered a couple of years ago, of about 870,000 ounces. This is my numbers. It's not 43101 compliant and not the company's. 870,000 ounces, about 1.5 grams, with about 4.2 million ounces of silver at 7 grams for just the South Zone as an open pit amenable project. Their 2020 drill program, which is about 30,000 meters with 2 rigs, is the largest program that has happened in this area ever. And so now we're going to see steady news flow. Unfortunately, the drill results so far haven't been stellar, and so the company's share price has reflected that. But now they've just discovered this new zone with outcropping veins that have never been drill tested, and grab samples from that came back at 50 grams and over 165 grams per ton silver. They've moved a rig there, and so we should hopefully see results from there in the next 3 to 4 weeks. And then Origen Royalties is a bit of a different take, because right now prospect generators, that Evrim Resources, which was the company that Origen initially was, their idea, prospector generator model, maintain tight share structure, let others drill your projects. That in this kind of environment where financing risk isn't very high is not a highly sought business model by investors. But we've seen several IPOs, large ones, of new royalty companies as this model is valued at a premium. And so following a bit more of a hybrid model, because there's not a lot of companies that are actually generating their own royalties versus acquiring them, Evram's now acquired another royalty called Silicon in Nevada, which Anglo American are basically working on, which could be a significant royalty from Renaissance Gold, which is a company they acquired. And their flagship royalty, which is a 2% NSR on the Ermitaño veins in Mexico, that First Majestic are working on, is a near-term cash flow royalty. It's not like something that's coming out in 5 to 10 years. So I'll let Patty talk about that later, the CEO. And lastly, an ASX company, GBM Resources, that might not be familiar to many people, but I am familiar with the management team, and you may be as well. Steve Nano, who's leading the exploration there, their flagship project, Mount Coolon in Queensland. They're consolidating the ground in this low sulfidation epithermal gold environment to basically get a significant lime package. I mean, but they've got other projects, and one is an actual operation that they're looking to do. The CEO, Peter Roner, is a metallurgist, and basically they've got a small heap leach project right now in South Australia that is operating, generating revenue, which should cover, once it's steady state, their G&A and a bit of exploration expenditures. And also in the Fosterville district, they have dealt a project called Malmsbury to Novo Resources. Okay, and that's it for me. So thank you for listening. Again, this is Exploration Insights. We have a newsletter, explorationinsights.com, and we've got a lot of free stuff on the website.